There are few experiences more disheartening in the study of speculation than to witness a stock, which has been dormant for weeks, suddenly burst into life. It decisively breaks through a line of resistance that has capped every previous rally. The volume surges, the tape runs hot, and every indication points to the beginning of a sustained upward campaign. You, the trader, act on this evidence and take a position, only to watch in disbelief as the momentum vanishes, the price falters, and the stock collapses back below the very level it just conquered, taking your capital and your confidence with it. What if this demoralizing event was not a random failure of the market? What if it was not your poor timing, but rather a meticulously engineered trap, set by an intelligence far greater than that of the average market participant? Richard D. Wyckoff did not merely entertain this idea. He built his entire methodology upon this foundational truth. He understood that the market was a stage, and to succeed, one had to learn to distinguish the real performance from the deliberate deceptions. This analysis will illuminate the methods he developed to do precisely that. Before we dissect these professional methods, please take a moment to subscribe and comment below. This feedback is invaluable and ensures these deep analytical studies reach a wider audience of serious traders. To comprehend the nature of these traps, one must first understand the entity that sets them. Wyckoff postulated the existence of a single controlling intelligence which he termed the Composite Operator. This is not one individual, but the amalgamated mind of the largest, best informed, and most powerful financial interests. This Composite Operator, or CO, thinks and acts as one. He is patient, resourceful, and utterly devoid of emotion. His business model is elegantly simple: to accumulate a large line of stock at the lowest possible prices from a misinformed public, and then to distribute that same stock at the highest possible prices back to that public now consumed by euphoria. False breakouts and breakdowns are the primary tools of this trade. A sudden, sharp break below a well-defined support level, a bear trap, is designed to induce panic, frightening the public into selling their shares directly into the CO's waiting hands. Conversely, a dramatic, explosive surge above a clear resistance level, a bull trap, is engineered to ignite greed, compelling the public to buy the CO's shares at the apex of the move. These are not accidents. They are calculated maneuvers in a campaign for capital. The field of battle where these campaigns are waged is the trading range. A stock does not move from a low point to a high point by sheer chance. Its major movements are preceded by distinct periods of preparation. A trading range is such a period, a zone of equilibrium where the stock's ownership is transferred from one class of trader to another. When the composite operator wishes to accumulate a stock, he will operate within a trading range, buying on weakness and selling small amounts on strength to keep the price from advancing prematurely. This entire process is known as accumulation. When he has acquired his desired line of stock and wishes to sell, he will conduct a campaign of distribution within a new, higher trading range, selling on strength and supporting the price on weakness to mask his true intent. A breakout from this range, therefore, is the culmination of this entire hidden process. A genuine breakout signals that the CO has completed his campaign and is ready to initiate a sustained trend. A false breakout, however, is his final, masterful deception, a maneuver designed to catch the very last of the uninformed traders on the wrong side of the market before the true trend begins in the opposite direction. Wyckoff identified and codified the two primal traps that form the basis of most market deception. The first is the bear trap, which he named the spring or shakeout. Its anatomy is precise and purposeful. After a stock has traded within a range for some time, establishing a clear floor of support, the price is suddenly and deliberately plunged below that support level. To the untrained eye, this appears to be the resumption of a downtrend. It triggers stop-loss orders placed by nervous bulls and attracts fresh short sellers who believe they are capitalizing on a new breakdown. This is the exact reaction the composite operator desires. The purpose of the spring is to create a wave of panic selling, allowing the CO to absorb the final available shares at the most advantageous prices. The key to identifying a spring lies in what happens next. A genuine breakdown would attract follow-through selling, and the price would continue to fall. In a spring, the opposite occurs. The price quickly reverses and climbs back into the original trading range, often on increasing volume. The plunge failed to attract significant supply. It was a test that proved demand was now in control. The second of these primal traps is the bull trap, which Wyckoff termed the upthrust. In a period of distribution, after the composite operator has sold the majority of his line to an eager public, he may employ an upthrust to dispose of his final holdings. The mechanics are the inverse of the spring. The price is engineered to surge above a clear line of resistance, often a previous high within the trading range. This action screams strength to the public. It attracts breakout traders, those who have been waiting for confirmation of a new uptrend, and creates a sense of urgency, the fear of missing out. As this wave of public buying floods the market, the composite operator meets this demand with the last of his own supply, selling into the manufactured excitement at peak prices. The defining characteristic of an upthrust like the spring is the failure to follow through. The price is unable to hold its gains above the old resistance. It stalls, churns, and then swiftly falls back into the trading range. The surge in volume that accompanied the breakout was not the volume of committed professional buying, but rather the climactic transfer of ownership from strong hands to weak. Now that we have established the anatomy of these deceptions, we must turn to the diagnostic process. How did Wyckoff, in real time, differentiate a genuine market thrust from a deliberately set trap? He did not rely on any single indicator, but on a confluence of evidence derived from 3 critical tests, forming a multi-dimensional view of the market's true intention. The first and most important of these is the test of volume, which Wyckoff considered to be the very voice of the market. He operated on a fundamental law. Volume represents the effort, while the price movement represents the result. A harmonious relationship between the two confirms a move, whereas a divergence between them is a stark warning of manipulation. A genuine breakout, whether up or down, must be accompanied by a clear and decisive expansion in volume. This increased volume is the footprint of the composite operator. It signifies that large capital is committed to the move and is forcefully pushing the price into a new trend. This is the sound of authenticity, a harmony between effort and result. The signature of a false breakout, by contrast, is one of discord. It typically manifests in 2 ways. The first is a breakout that occurs on low, anemic, or diminishing volume. This is a telltale sign of a lack of professional sponsorship. The effort is weak and cannot produce a sustainable result. It suggests that the demand or supply required to fuel a new trend is simply not present. The second and more subtle sign of a false breakout is a move that occurs on excessively high churning volume, yet makes little upward price progress. This often happens during an upthrust. The public, gripped by excitement, is buying with abandon, creating enormous volume. However, the price struggles to advance and the bars may have narrow spreads. This is because the massive public demand, the effort, is being met and absorbed by an even greater hidden wall of supply from the composite operator, an opposing effort. The result is negligible. This churning action at a peak is the very definition of distribution, and the breakout is a deception. The second diagnostic is the test of price action, which analyzes the character and quality of the movement itself. It is not enough to know that a level has been breached. One must judge how it was breached and how the market behaves immediately afterward. A genuine breakout exhibits what Wyckoff called ease of movement. The price slices through the former resistance or support level with authority on wide, spreading price bars that close near their extremes. It should feel effortless, as if a barrier has been removed and the path is now clear. A false breakout, conversely, is characterized by struggle, The price may pierce the level, but it does so with difficulty. The price bars may have long wicks or tails, indicating that the opposing force immediately engaged in battle. An upthrust may poke its head above resistance only to be beaten back down, closing the bar near its open or its low. This shows that sellers emerged the moment the price entered new high ground. The subsequent action is equally critical. Wyckoff placed immense importance on what he called the backup to the edge of the creek. After a stock makes a genuine jump across the creek, the breakout, it will often return for a final test of the breakout point. This backup or pullback should occur on significantly diminished volume. If the stock holds the old resistance level as new support and then turns up again, it provides the highest degree of confirmation that the breakout is real. Waiting for this test requires patience, but it is the professional's method for avoiding traps, as a false breakout will simply fail this test and collapse back into the range. While Wyckoff taught us to patiently observe the market's behavior over time following a breakout, waiting for confirmation like a backup to the edge of the creek, his contemporary William Gann approached the element of time from a completely different, almost mathematical perspective. Gann believed that significant breakouts and failures were often predetermined by specific time cycles and harmonic relationships. He sought to forecast when a breakout was likely to be genuine or false based on its timing. For those intrigued by this fascinating dimension of market forecasting, our sister channel, William Gann Trading Insights, explores these profound concepts of time and price harmony. The third and final diagnostic is the test of context, which is governed by Wyckoff's overarching law of cause and effect. This law states that in order to have a significant effect, a sustained price trend, you must first have a commensurate cause, a period of preparation. A breakout does not occur in a vacuum. It is the result of a preceding campaign of accumulation or distribution. Therefore, before validating any breakout, the astute analyst must first study the trading range from which it emerges. Has the cause been sufficiently built to produce the anticipated effect? One must ask, how long has the stock been trading in this range? Was the volume signature within the range indicative of accumulation absorption of supply on weakness or distribution selling into strength? A breakout that emerges from a long, well-structured period of accumulation, where supply has been systematically removed from the market, has a high probability of success. It is the logical culmination of the CO's campaign. Conversely, a breakout that appears after a very short, ill-defined trading range is immediately suspect. It lacks the necessary cause, the foundational fuel required to sustain a major move. Such breakouts are often nothing more than temporary emotional spikes, easily reversed and frequently revealed to be traps. To know the names of the tools is one thing. To possess the skill and judgment to use them effectively is another entirely. An amateur can learn to identify a spring or an upthrust on a historical chart, but this academic knowledge alone is insufficient to build a career. The true mastery of the Wyckoff method lies in the synthesis of these diagnostic tools into a cohesive, disciplined philosophy of action. It is this elevation from technician to strategist that separates the fleeting success of the amateur from the enduring longevity of the professional. What follows are the core principles that govern this professional mindset. The first and perhaps most vital of these principles is to trade the reaction, not the initial action. The initial breakout, the action, is the most emotionally charged moment. It is loud, fast, and creates an overwhelming sense of urgency. The amateur trader is a creature of impulse. He sees this explosive move and, driven by the fear of missing out, jumps into the market at the worst possible price, at the moment of maximum risk. The professional, however, has cultivated the supreme virtue of patience. He understands that this initial thrust is often chaotic and deceptive. He willingly lets it go, choosing instead to wait for the subsequent reaction, the first pullback or test that follows the breakout. This is the moment of greatest clarity. By waiting for the backup to the edge of the creek, the professional allows the market to prove itself. A genuine breakout will hold its ground. The old line of resistance will become a new floor of support, and the test will occur on light volume, confirming that supply has been exhausted. A false breakout, a trap, will not afford such an opportunity. It will simply fail and collapse. By trading the reaction, the trader avoids the vast majority of traps, enters at a lower risk point, and operates based on confirmed strength rather than speculative hope. This patience is not passive waiting. It is an active, strategic decision to engage with the market only when the evidence is overwhelmingly in one's favor. The second principle forms the bedrock of all professional speculation. The unwavering acceptance that your analysis can, and at times will, be wrong. The market is the ultimate arbiter, and no amount of study can grant perfect foresight. Therefore, the professional's best and final defense against a trap that he has failed to identify is the indispensable, correctly placed stop-loss order. An amateur views a triggered stop as a failure. A professional sees it as a routine, calculated business expense, the premium paid on his capital insurance. Having a stop-loss is not enough. Its placement must be logical. It must be set at a point that definitively invalidates the original thesis for the trade. If one enters on the successful test of a breakout, the backup to the creek, the logical stop position is just below the low of that test. A decline below this point would suggest that the initial strength was illusory. Alternatively, a stop might be placed at a point back within the middle of the preceding trading range. A return to this area proves that the breakout has failed and that the prior conditions of equilibrium are still in force. The stop is not an arbitrary number. It is a logical line in the sand. Its execution is a declaration that the initial judgment was incorrect, and the professional exits without argument or ego, preserving his capital to fight another day. We have discussed the specific anatomy of traps and the diagnostic tools to identify them. But how does one cultivate the patience to wait for confirmation, the judgment to read volume correctly, and the discipline to always honor a stop-loss? This is the transition from knowledge to professional wisdom. This very journey is the core of Richard Wyckoff's seminal work, How I Trade and Invest in Stocks and Bonds. The adapted edition by Max Davidson doesn't just teach you to see patterns. It teaches you how to think like a market professional, making sound judgments under pressure. If this video is the map of the battlefield, that book is the training manual for the soldier. You can find the link in the description. In conclusion, let us distill these observations into a final, coherent thought. The stock market is not a passive mechanism for wealth generation. It is a dynamic arena where informed, intelligent capital actively competes against the uninformed and the emotional. False breakouts are not market noise. They are the finely honed weapons of the composite operator, designed to prey on the predictable human impulses of greed and fear. Your defense against these maneuvers is not a more complex indicator or a secret algorithm. It is a return to first principles, the foundational triad of Wyckoff's analysis, a profound understanding of volume, a disciplined interpretation of price action, and a constant awareness of context. The ultimate goal of the Wyckoff method is not to achieve the impossible task of predicting every minor fluctuation, but to cultivate a state of mind that operates in harmony with the market's true rhythm. It is a methodology for avoiding the obvious traps, for managing risk with unflinching discipline, and for acting decisively only when the weight of the evidence is firmly on your side. This is the path to survival, and ultimately to success in the great game of speculation.